My name is James Neathery. I'm with James C. Neathery and Associates. We're in Alvarado, Texas. I was born and raised in Fort Worth, and I appreciate the opportunity to be here. We're here. They were being a little bit modest. They're here because, of course, I encourage them to be here and I ask them to be here. But I'm trying to expose them to outside of the box thinkers, creative people that are entrepreneurs, right? And that's really why we're here, is because that's what y'all are. We do a lot of work in real estate. A little bit of background about me, not very much, but I've been in the life insurance business and an investment advisor for a little over 25 years. About the last probably 8 to 10 years, I like real estate a lot. If I didn't do what I do, I would only be doing real estate. I like commercial properties and apartment complexes. Have lots of real estate clients all across the country, investors, some of which I've never met. I assure you, they're all outside of the box thinkers and creative people, right? And that's why I like to do business with them. Consequently, I try to do as much as I can with them. Has anyone in here heard of the infinite banking concept? Becoming your own banker? Okay. Well, the concept is really a 10-hour course. Okay, now I've got a limited amount of time here, so what I'm going to go through is an introduction to the infinite banking concept. And what I'm going to share with you today is really a lot of concept. It's a lot of concept. And I've got some numbers here. But it's my belief, what I have come to believe, that if you don't understand this concept, the details don't matter. All right, but if you do understand the concept, then the details don't matter. All right, but since the details are really your money, my money, I understand they're extremely important. So the challenge that I feel like I have is trying to bridge the gap between the details and the concept without making your eyes glaze over, right? I married a beautiful girl from West Des Moines, Iowa. She's an English major. She can correct my English and my eyes start glazing over, right? But if I talk too long about numbers with her, her eyes glaze over. It's a challenge to get that happy medium, okay? But before I get into the infinite banking concept, I'm going to run through qualified retirement plans. All of y'all are aware of qualified retirement plans. So I'm going to do a little compare and contrast, okay? And the reason I'm going to talk about qualified retirement plans, and I'm talking about the traditional qualified plans, right? The IRAs, 401ks, 403bs, self-directed IRAs. And I'll talk a little bit about Roth. We all are aware of these, but I'm going to kind of go through it in a way that most financial gurus don't, right? And kind of show you the other side or get you encouraged to look at the other side. And the main reason is because this is where all of America has been taught to build their wealth. And right now, most of America, the majority of Americans hold their wealth in their qualified retirement plans and their primary residence, right? So all qualified plans beg 3 questions. Number 1, are taxes going to go up in the future or are they going to go down? That's a bona fide, legitimate question.
They will go up.
They're going to go up. Of course they're going up. And I've got a 1913-1040 form. How many of y'all have seen that? 1913-1040 form, right? All right, well, this is when the income tax became permanent, right? I know the numbers are small, I get it, but I want you to see down here in the lower left that you could earn $20,000 a year in income without paying any kind of tax on it. The next $30,000, between $20,000 and $50,000 in income, you only had to pay a 1% tax on that. That, and then it graduates up to 6%. That's the equivalent of being able to earn $120,000 in income today without paying tax. So yeah, taxes are going up. Look, the exemptions, the carryovers, the exclusions, the deductions, all of that changes. But the net amount of dollars that we're paying on an annual basis are going up. All right? So the second question that all qualified plans beg is, would you rather pay taxes on a little or a lot? The seed or the harvest? What? The seed, of course, right? All right, now think about that. If the underlying investment is successful, you're going to have a whole lot of money or value. And then you're going to be in a higher tax bracket and pay higher taxes on a larger amount. And this is probably the reason that y'all are even doing real estate, right? You don't trust the guru that lives 6,000 miles away to manage your money, to get a high rate of return, to compensate for inflation and all that. So, we all go out and get self-directed IRAs and start using the money to get that higher rate of return, which I believe that's absolutely what you should do. You're using your own God-given abilities and talents, right, in the real estate. You're going to win hands down against any financial guru, however far they are away, right? Well, in a qualified plan, you're still paying taxes on that money. It's all deferred, right? And then the third question, is a dollar worth more today or is it worth more in the future? It's always worth more today. Always. And here's the way I express it. When you were a child, how many candy bars could you buy with $1? Handful. How many can you buy with $1 today? Maybe one. Look, y'all should be eating apples, right? Okay. You can buy one today, maybe if you go to the dollar store. Look, $1 is always worth more today. So the qualified plans violate those three basic truths, right? Taxes are going to go up in the future. If the underlying investment is successful, you're going to pay taxes on a larger amount. And when you take dollars out of that qualified plan, those dollars are going to be worth less than the dollars you contributed all throughout that period. Now, even the Roth violates that third principle because the dollars that come out of the Roth, yep, they're tax-free, but they're still worth less than the dollars that you put in. All right? And then, of course, your income levels will potentially phase you out of even being able to participate into a Roth, and it's limited. How much money you can put into a Roth on an annual basis is limited. You put pennies in and you have access to pennies, and then you've got to go do business with pennies, right? Then the Roth conversion, it's a taxable event. Okay, but here on the self-directed IRA, you do a self-directed Roth IRA, then you start going through the regulations and the compliance to use that money without any headaches between now and whenever. That's getting more and more difficult and expensive to comply with the regulations on a self-directed IRA. All right? All right, so let's take a closer look at the timeline. I'm just using an example of an individual that's 19 and a half. They're ahead of the curve. They started saving money, right? Most of them don't at 20. Well, for the next 40 years, they're locking their money up in a qualified retirement plan because between 19 and a half and 59 and a half, you're separating yourself from your capital. Because if you access that capital, there's going to be a 10% penalty and then ordinary income whenever you withdraw that money. And I understand we can all borrow money from the 401k, right? Up to $50,000 or 50% of the value. But you tell me who controls that loan when you go borrow money from the 401k. They tell you what interest rate you're going to pay it back at, and they tell you the time period you're going to pay it back in. And then if you get mad and quit, get fired, get laid off, get sick, then it becomes a taxable distribution, right? But there's nothing wrong with that. All right, so that means that 25 to 35% of the time, you're always paying ordinary income tax on that money, plus the penalty. Now, if you reach 59 and a half, you've entered into this 11-year period. It's magical, right? You can take as much out, as little out, or not, as often as you would like. Then you turn 70 and a half. In my example, I'm letting this individual live, and there's no penalties during that 11-year time period, right? This individual I'm letting live to 100. Even though there's no penalties in that 11 years, it's still 100% taxable. I promise you, I've got clients, many people that are 70 and a half that are having to take those required minimum distributions once they reach 70 and a half, and they don't even want it. James, I don't want to take my money. Doesn't matter. You have to take it. It has to be distributed. Uncle Sam wants his share, right, while you're alive. If you don't take that required minimum distribution, you'll be penalized 50% of what you should have taken out but did not take out. So that means 80 to 85% of the time, the plan owner is in a penalty phase. 45% of all qualified plans liquidate fully or partially prior to retirement. In 2009, 10, and 11, that number went up to over 70% of all qualified plans liquidate fully or partially. Now you tell me, why would anybody put money somewhere and then give up 30 to 40% of it before they get to the intended use? Right? It's because life happens. People move, people get sick, job loss. Right? Life happens. Right? Or we wouldn't do that. But that's the timeline of a qualified plan. And I'm just saying that there is a better way. The question here is, who do you think this plan is designed for? You, your family, Uncle Sam? That's the easiest question I'm going to ask all day, right? We all know that that's Uncle Sam. It's designed for Uncle Sam. You think about that. You're putting your money in a qualified plan. You're separating yourself from the majority of your capital, and you want to go do a deal, right? You tell me what's king in real estate besides location, location, location. Cash. Cash has been king. Cash is king. Cash is going to continue to be king. But all your cash is in your primary residence or your qualified plan. So now you're beholden to the third-party lender, whoever they are. Credit cards, hard money lenders, your neighbor's IRA, your neighbor's 401k, right? And then if I continue here for a minute, your money's in a qualified plan. If you're successful, you're going to be in about the 30% tax bracket, ballpark figure, right? So let's say you have $1 million in qualified retirement money by the time you retire. How much of that money is really yours if you're in the 30% tax bracket? About $700,000. Well, tell me who paid all the fees on Uncle Sam's $300,000 over all those years. Right? You. And who took all the risk? You. So all qualified plans also violate the law of use because you give up or restrict the control or use or the liquidity of your money. Then of course I've gone through the timeline. Most of the time you're in a qualified plan, you're in a penalty period. Of course you pay all the fees, and of course you assume all the risk. I mean, what's new in America today? Not much. The consumer pays for everything, right? So the comparison, is that a valid place to build money? Absolutely. But I want to talk today about the infinite banking concept and the genesis of this concept. The creator of this concept is Nelson Nash, and this is just the cover of a book that he wrote in 2000, right? And it's called Becoming Your Own Banker, unlocking the infinite banking concept, okay? And I encourage everyone in here to buy this book and read it before the sun goes down. All right, there's two foundational concepts that have to make sense. You've got to wrap your mind around for this concept to make sense for you, or for you to be okay with it. All right, number one is you finance everything you purchase. You either pay interest to someone else when you formally finance, or you give up the interest you could have otherwise earned when you pay cash. There are no exceptions to this. Richard Cantillon discovered this, I believe, in the 1500s. So whether we recognize it or not, it's a fact. Okay? And so we're going to talk about that. What is this interest that you could have earned otherwise when you pay cash? Right? Because the cash buyer says, oh my gosh, I'm paying cash because I don't want to pay anybody interest. But they discount the fact that they're losing interest they could have earned otherwise, right? So this is nothing more than a visual calculator. I'm using a 30-year time period. I'm illustrating a 5% rate of return, a safe money rate of return without risk. And then I'm illustrating a $30,000 cash purchase, a one-time cash purchase. Now, I don't care what it is. It can be an automobile. It could be a piece of equipment for my business. It could be a piece of real estate or an option in the real estate. Doesn't matter what it is. And I'm not talking about any of the profits that purchase could provide you. I'm only looking at the interest that you're going to lose or that is lost by paying cash. All right, so $30,000 would have grown to $129,658 in the lower right over a 30-year time period, earning 5%. But now you have whatever you purchased, right? And all the profits that it earned you. So I subtract that out, and the bottom green number is $99,658. And that is the cost of paying cash over a 30-year time period. Does that make sense? Right? Kind of?
So how is that like you're loaning out for $30,000?
Nope. This is just, I paid $30,000 for a car that my wife wanted.
So what are you earning on that exactly?
I'm not, because I bought the car. But I bought the car with cash because I didn't want to pay the dealer any finance, any interest. Right? So I'm avoiding interest by paying cash. So I'm isolating what it really cost me to pay cash with this calculator. Right? So if I didn't buy or make the purchase, I'd have $129,000. But since I bought that item, I've lost $99,658 over that 30-year time period. That kind of makes sense? Well, stay with me. My question here is, if you could capture the equivalent of any of that lost interest and have whatever you purchased, would you want to? Would you want to learn how to do that? Of course you would, right? And how soon would you want to start learning that? Yes, 30 years ago. And I'm telling you, with this concept, you can capture the equivalent of that lost interest and have the asset that you purchased. All right? Now people are starting to lean in. I like that. Okay. The second concept, the truth, foundational, that has to make sense to you, is the banking process. And we're just going to look at the banking process. What's going on in the big wide world today? So I'm illustrating a $100,000 deposit into a bank. And the bank's paying 4% on the money. That should date this PowerPoint, shouldn't it? Because the banks don't pay 4% today. But I'm a generous guy. I'll err on the side of caution. The question here is, do you know what the bank is going to do with your money? Reinvest it, loan it out. You know, they loan it out. But why? Their money is Tier 1 capital. It's too valuable to lend out. But before they lend your money, they inflate it out of thin air. With your deposit, they create, and actually it's 12 times today, I'm still being conservative. They create $900,000 out of thin air, and then they put that money into motion. They create all kinds of loan portfolios. Now, I've created 6 loan portfolios here, and I've assigned different interest rates to them. You know, sometimes I get a little pushback. James, you got 8% on an automobile loan portfolio. I get it. You know, the advertisement on TV today, come buy a car, 1%, 0%, 2% financing. Will you tell me, can you do that on a pre-owned automobile? No. And a 0% financing is nothing but a method of discounting. All right, y'all remember GMAC? Now it's Ally Bank. Back in 2008, General Motors owned GMAC. Did you know GMAC was the most profitable arm of General Motors? Did you know that? Now, how could that be the most profitable arm of General Motors at 0% financing? It couldn't be. Then they get into trouble. They have to start selling assets. You got to sell your most valuable asset first. That's why GMAC is now Ally Bank, right? Okay. So look, some of these automobiles, for example, are going to be paid early. Some are going to go to term. Some are going to be defaulted and repossessed. The bank is continually lending out money in that automobile portfolio over and over and over. And you think about that. You're 30 years old. You've been driving for, 10 years at least, 15 years. How many cars have you owned in the last 15 years? How many cars are you going to own in the next 15? Oh, you drive, your spouse drives, your children drive, your parents drive. All right, so I'm talking about financing just like the bank does over and over and over. They do the same thing with home mortgages, lines of credit, equipment, construction, and commercial real estate. Now, I go through here, and there are several ways to calculate this, and I'm just being straightforward and linear. They're paying you 4% on your money, and they're earning 44%. The question here is, how much more is the bank earning on your money than you are? Quite a bit. That's probably the most accurate answer. Most people say, well, they're making 40. You know, they're just thinking linear. They're paying me 4, they're earning 44, so they're making 40. Right? I'm saying 1,000%, and I'm still being conservative. I know the mathematician loves to get to the numbers, right? Here we go. How do you get to 40? 44 minus 4 equals 40. How did I get to 1,000%? Here are the keystrokes. Simple calculator, right? You don't have to have a 12P, you know, a HP 12C or the latest one that you young people use. You know, you can calculate the distance to the moon and back. Simple keystroke. 4 times 1,000% equals 40. And actually, this should be 1,800%. And then one more on top of that. In a low interest rate environment, the banks make more money than in a high interest rate environment. All right, but you can learn all this. You know, you can learn every bit of this, how a bank works without, I mean, you can go deep into that as you want, okay? Now look, the bank's doing something that we can't do. They're printing money out of thin air, right? That's counterfeit. It's federal offense. You won't see the light of day if you just start printing some money. No question. But every one of y'all drove here in an automobile, right? There's not a single one of y'all that has slept in the rain unless you wanted to, right? And we've all had lines of credit and credit cards. We've all done equipment or hard money lending in real estate. We've all had construction loans or student loans or whatever it is. So yes, you cannot print money out of thin air, but you can put your own money into motion. You can finance your own automobiles, mortgages, the things that you were going to finance anyway, and you can capture the lost opportunity cost or that interest for doing so. And you can do it in a tax-free entity that you own and control, right? So we can't print money out of thin air, but we can put our own money into motion, right? We can add velocity to money. All right, so the word bank, if I could talk about that for a minute. I'm told the etymology of the word of bank is bench. Because you go back 6,000 years in history, the worshipers come to the temple to pay their tithes and homages. The money changers worked off of a bench outside the temple, right? Now, like I said, I married a beautiful girl from West Des Moines, Iowa. It gets really cold up there, and it snows and the wind blows, too, right? So when it's snowing and the wind's blowing and all that wind piles up beside a barn or a building, what do you call that pile of snow?
Snowbank.
A snowbank, that's right. If I'm floating down a river in a canoe, what do you call the pile of dirt on both sides of the river? Come on, it's a riverbank. We probably fished from them, right? If I'm going to go give blood tomorrow, where would I go give blood? A blood bank. So bank can also be an aggregate of any one thing, right? Now, if we looked up, Webster's dictionary, the word bank today, or banking, it would talk about the movement of money, deposits, withdrawals, loans, loan repayments, checks, the flow and the movement of money, right? The process of banking, moving money. And I know that, look, words have power, words have meaning. And I know I'm talking semantics, but I just want you to think, is this not correct that if I put money somewhere and I have access to that money, it goes in and goes out, I'm just performing the banking function. Right? That's all I'm doing is practicing banking. Now this is a trick question, okay? But there's only one. Who would you rather be, the banker or the borrower? Look, the borrower has the need to access capital. Right? Aren't we all the borrower because we all need capital? You can't operate in any business, much less a real estate business, without access to capital. So we're all already the borrower. We need access to capital. The banker controls the loan. He tells you when you're going to pay it back, how you're going to, or the third party lender, right? How you're going to pay it back, when you're going to pay it back, at what rate. And then if you do anything that he doesn't like along the way, he shows up and starts calling notes and repossessing property. He has all the control. He needs access to capital. The trick part of this question is, and it's trick because it's not on here, who makes all the profits from that transaction? It's the bank owner, Right? The bank owner makes all the control. The banker works for the bank owner. Does your bank, have y'all received a dividend check from your bank? No? Credit card? Or mutual credit union? Right? Because you're a member. Right? Members own credit unions. Right? Do you know banks pay dividends too? Yeah. They get paid to the owner though. Right? If you're a member of the credit union, you know, you're owner of the credit union, and that's why you get a dividend. Well, if you're an owner of the bank, you get a dividend as well. So my position here is, yep, we need access to capital. We want access to capital. We want to control that access to the capital, and then we want to profit from that access to capital. Now I'm going to look at spending method for a moment. And I'm going to compare cash versus formal financing. I've just got a baseline of 0. You know, most people don't have money. Right? They don't have money. So when they want access to capital, they go use somebody else's money. They go borrow money right there. And then they pay it back over some time frame that the lender required. They still didn't develop any discipline over that time period either. And for the next purchase that they make, they're going right back to the third party lender. And he's going to tell them how they're going to pay it back. That's how they live their life. And you can be very profitable, right? I can go make a ton of money with that other people's money. Right? No problem. Well, here's the cash buyer. You know, you got to save up cash before you make a cash purchase. All right? You got to have it saved up somewhere. All right? And so it's not like if I go buy a car, that's not the only car that I'm ever going to own. I'm going to buy the next car and the next car, and if I don't want to pay them interest, I'm just going to save it up and make my purchase. So this is what the cash buyer does all throughout their life. My point here is they both wind up at the same place. Right? All right. Now I want to talk about an exponential curve. Y'all know what an exponential curve is, right? You put money anywhere that has any kind of a rate of a return, and you add enough time, or you leave it alone, let it compound. It compounds, and eventually that compounding goes straight up, the exponential curve. Right? All right. Now what if we could have an account that had an exponential curve, and then we put the same spending pattern on that exponential curve. We put money in, we make loans against that, right? Go buy a piece of real estate that's cash flowing and appreciating, and we go buy another one and another one and another one and another one and then another one. The only thing that changed is where the money was coming from and where the money was going back to. Right? The pattern didn't change. The things we were buying didn't change. We just put our money in somewhere, an account that had an exponential curve. And then we just used that money, banking, right, to make the purchases that we were going to make anyway over time. And not only do you get the things that you purchased, you get all that lost, or the equivalent of that lost interest that you either paid or gave up. That's pretty powerful, right? So it's not get rich or anything. So talking about compounding for a minute, y'all have all seen this, right? Would you want a penny today and have it doubled every day for 30 days, or would you like $1 million today? Which would you choose if you had that choice? Have y'all seen this? Right? You'd be surprised how many people say, I'll take the $1 million today, right? A penny a day doubled every day for 30 days turns into over $5.3 million. And I'm just using this to as an example of the power of compounding. Okay? My question here is, when would you want to stop or interrupt that compounding? How about we stop it on the 15th day? You put a penny in, it doubled every day, 15 days, you have $163, right? As soon as you interrupt the compounding, you've got to start over if you want any more compounding, right? So if we interrupted this compounding in the middle of the month and then we continued for a month, we would wind up with $327 instead of the $5.3 million. Does that make sense on the power of compounding? So what if you could use your capital without ever interrupting the compounding forever? And then what if it compounded at interest and dividends? Would you want to interrupt that? And no, of course you wouldn't, right? But what if you could use that money, have access to the capital because you're the banker, without interrupting the compounding, so you could go and do what you were going to do anyway, invest in real estate, buying cars, vacations, education. Everything you purchase is financed. So if you financed everything you purchase from an entity that compounds forever, would it be worth looking at? Yes. So now, this is exactly what I'm talking about. I'm talking about putting money into an entity. That entity happens to be a dividend-paying whole life insurance policy issued by a mutual company structured for cash. Okay? This is not typical or traditional life insurance. When I said life insurance, what did y'all think about? Didn't y'all think about death benefit? Y'all have all been taught to buy life insurance, get the highest death benefit possible, and pay the least amount of money for it. This is the exact opposite. I want to put as much into a life insurance policy structured this way as the law will allow, with the least amount of death benefit. All right, this is the first paradigm shift in thinking. All right, now if I do put a lot of money in there, you know the capital stock of a bank is money, right? All right. So I'm trying to get money into the life insurance policy. As soon as I do, it compounds forever. Interest and dividends, tax-free. Now I have access to it by contract, by guaranteed contract. I have access to it. So I can go finance my automobile, my wife's automobile, my children's automobile, my cousin's automobile, my mother-in-law's automobile. I can finance all the automobiles I want to, over and over and over and over and over and over and over. Depends on how much you put in. If I'm going to buy a $50,000 car, I better get $50,000 in there, right? I can finance mortgages. I can use it as lines of credit. You know, a line of credit in business, who controls that? If I go down to the bank and get a 1-year line of credit or a 2-year line of credit, who controls that line of credit? The bank, right? So this is really about controlling the banking function in your life, okay? But I put money in. I can't inflate money like the bank did, but I can put my own money into motion over and over and over and over and over and maintain control for the rest of my life. These things operate like a pre-engineered tax-free trust. That's pretty powerful. Now here's an example. I'm not trying to beat you up with numbers. I get it. And I understand that you haven't heard of this concept. And I come in here and talk about life insurance, and I'm talking about financing. Well, I think all y'all can wrap your mind around this with a little bit of investigation without prior consent. So look, this is a real life insurance policy. The guy's 39 years old, standard non-tobacco. And I want you to see, I know they're little, but in the upper right, this guy's putting $20,000 a year in premium into a policy. This is a typical life insurance policy. Blow it up a little. By the end of the year, this guy has $562 in cash value, but he's got $1.1 million in death benefit. This is what typical life insurance is. He'd have to pay in this bad boy for 20 years before the total premium and the total cash value equals. But if he died, his family's going to be really wealthy, right? It starts out at $1 million. And by the time this guy's 70, he has $1.7 million in death benefit. Traditional use of life insurance. Somebody is going to be taken care of if I die early, right? And good job. If you need death benefit, you should address that. Now this is the same guy, 39 years old, standard non-tobacco, but this is built for the infinite banking concept, and I'm still using it's 19,9999.5. It's a rounding. I'm still using a $20,000 premium, okay? Now this guy pays in 20, and he has access to $13,000. By the end of the year, he has access to $13,295. But he only has $577,000 in death benefit. That's the lowest death benefit that this guy could purchase with a $20,000 premium and have access to $13,000 tax-free. All right, least death benefit you can get is as much cash value as you can get. And now I'm illustrating this guy. He's only paying premiums for 7 years. So he's put in $140,000 in premium, and he only has access to $130,000. This is where the financial guru, the brother-in-law, the guy who has arrived, says, "My God, I can't believe you put money into a life. If you put $20,000 in, and you have access to 13. Oh, James Neathery, he's making $7,000 on you. I can't believe you do. His kids go to nice schools. His wife travels the world. I can't believe you do that. You should be putting your money with me in the stock market, or gold, silver, or real estate, or whatever." All right. The second year, $20,000 goes in. Now I only have access to $27,000. The guy's still going to ridicule me. "I can't believe you did that. Neathery's living high on the hog. His wife's driving a nice car. His kids going to nice schools. I can't believe you did that. Have you seen what the stock market's done?" He never once, never will they ask, "Hey, what'd you do with that $13,000? Did you finance a car? Did you finance a vacation? Or that $27,000 in the last year? Did you have $30,000 credit card debt that you were going to pay off first and then start saving money?" Right? He never asked that. And Neathery says, "No, don't pay off the credit cards. Get the money into a life insurance policy, create that compounding forever, and then use that cash value to get out of debt," or whatever it is you were going to do anyway. All right? Okay, my point here is it takes this guy 8 or 9 years to have as much cash value as he paid in premium. Right? Oh, that's too long. You tell me how many properties I can buy for $45,000, or how many options I can buy for $45,000 in the real estate business, or how much can I leverage 45? I take $45,000 cash down to my banker, and I want to finance a $180,000 home. Is he going to let me do that? Yeah, absolutely. I can leverage the fire out of that if I want to. Right? Okay, but now I'm showing that he does not pay. The premium drops in year 8 to $6,625. But I'm showing that this policy, he is surrendering dividends and death benefit to pay that policy. So there is no outlay from him. He just capitalized the system. He got money in there. And now he has access to $107,000. No, I'm sorry, $130,000. In year 7, he's put 140 in. He has access to 130. Now I got real estate clients. They don't do deals unless they make 20 or 22%. Bonafide, they won't even do the deal at 14 or 17%, which boggles my mind. But that's their. You tell me how much money you can earn on $130,000 in the real estate business, right? So now I've got an asset. I've got life insurance. It's an appreciating asset, and it's going to cash flow. And it's got internal rates of return, right? Now I can take that cash value collaterally. I can call the insurance company and tell them to send me a check. I didn't tell them to liquidate my policy to interrupt the compounding. I told them to send me a check. By contract, they have to send me a check right up to my cash value. Now I have that check. And I'm going to pay the company interest too, right? How much can I go create with $130,000? Can I go buy another asset that appreciates and cash flows, that's real property that I own and control? Yeah, I can. Now, if I buy that piece of real estate, you tell me who's responsible, who ultimately pays, not responsible, who pays for the taxes, the repairs, and the insurance on your buy and hold properties? Who pays for that? Come on, y'all. The tenant pays for it. You're responsible for it, right? I mean, doesn't the tenant pay for everything? Doesn't he pay the taxes, or don't they pay the taxes, the repairs? Of course they do. Now, when they pay you, that money's got to go somewhere, right? And that's a cash flow. That's why you bought the real estate. You created a cash flow on an appreciating asset, right? It's private property. Now, I just want you to see that I've created a pool of money with this dog of financial products. All you ever hear in the big wide world is life insurance is the world's worst place to put money. All right, we can all go home today and we get on the radio. Look on your radio and your email. We're inundated with noise in this world. And we're inundated in the financial world with noise. Noise, noise, noise. You know, this right here creates a noise canceling headset. Because there's nobody in the world going to tell you to put your money here, right? Unless they understand how these work and what they can do with them. All right. Now this is the very same policy, 39 years old, $20,000 in premium, $20,000 for 7 years, right? But in this example, I said, look, I want to write that check for $6,600 in the 8th year and beyond. I don't want the policy to pay its own premium, which is what the world tells you to do. If your policy has dividends, get it to reduce the premium, take the dividend in cash, don't leave it in the policy, for God's sakes, whatever you do, right? All right, so I want you to see in the 8th year, $6,625, the guy decides to write the check instead of having the policy pay that. And then the increase, and look, in the 8th year, the increase in cash value in that 1 year was $10,597. Now I have that $130,000 out in real estate, vacations, automobiles, or education, whatever I was going to do anyway. All right, and I'm going to create, if I have any input, I'm going to create a cash flowing appreciating asset. And I'm going to take that cash flow and run it right through this policy. Wouldn't that make sense if I put $66.25 in and there was a, where am I here? $10,597 increase? Shouldn't I do that? Let me ask you this. How many of y'all would write me a check today for $6,625 if you knew in 12 months you can come get $10,297? Yep, of course you would. Would you pay me $66,000 if you could come back in 12 months and see $109,000? Would you go borrow $6,625,000 if you knew you could come back in 12 months and see a $10 million gain or increase? Of course you would. And you would too, right? When you see what's going on with a life insurance policy built this way, you literally cannot put enough money in fast enough. Right? Because if this was a $60,000 check in year 8, these should have been, or would have had to have been, $200,000 premium checks in the first 7 years. Right? Okay. Now I have this is an asset, I have it, and I'm using it like an operating account. I put money in there. This is the money I have access to. I'm going to finance automobiles, real estate, credit cards, and I'm just treating this like an operating account, right? Instead of using the bank or a 401k or an IRA as an operating account. That's all I'm doing here. Did it cost me money to start it? Yeah, it did. It sure did. You know, the colleges across the country are full of students. 4-year colleges, right? You've been to one, right? You tell me, why would anybody, or let me ask you this, how much money, how much in profits do you think those first-year students earn from their education? I go to college, right? Let's just take a doctor or a dentist. You know, a dentist graduates today with about $400,000 and up with student debt. Well, how much money did he make in dentistry in his first year, his second year, his third year, his fourth year? Why in the world would he put all that money in his education? Why in the world would he put all that money in there? Because he knows what he's going to make later, right? Why in the world was anybody put money in a 401k when they don't have access to it? Well, it's because what they think they're going to have later, right? So there's a startup cost. Why in the world would anybody put money in here and lose liquidity for a time period of a portion of that money? Because of what it does and what you can do with the money that you have access to. All right, so now I get down here at age 70. I know y'all can't see yourselves at 70. I get it. And also, the further out I go, the better these numbers look. I get it, okay? But you remember how much the death benefit that guy had on the first policy? He had about $1,700,000, I think. This guy, he dies at age 70. He's got 996 or 986 million. That's close enough to $1 million where I live. I'm from Fort Worth, Texas. I can get by with $14,000 difference, right? I wind up with more death benefit at natural mortality when you structure policies this way as you do when you go buy a death benefit with traditional or typical whole life insurance. Yeah, and here's two primary things that you always hear, always, always, always. I'm not going to, number one, take money out. This is an exponential curve that I created, 30 years prior. I'm not going to interrupt that compounding, so I'm not going to take that cash value out. I'm going to borrow against the cash value by contract, right? So I'm going to say insurance company, if I'm 70, I've got $572,000 in cash. I'm going to say, insurance company, send me a loan for $30,000 a year for the rest of my life. A loan is tax-free, and I'm going to let it compound, right? They're setting the interest rate, and I can pay it back or not. I'm controlling that loan. I can't control the interest rate. Now, let me tell you something else in addition to that. Insurance companies can't really control their interest rate either. You think about that. Interest rates are set by the Federal Reserve. You can't control that. I can't control that. These insurance companies can't control that either, right? But here's the term in my example right here. At age 70, I'm just going to say I'd probably say send me a $50,000 check because that policy will produce that. Now I've got a $50,000 check coming in. Is that taxable if it's a loan? Now if I'm in the 30% tax bracket, and I'm self-employed too, and you got to add 15 to that, and maybe I live in Florida or California, we can all get up in the 50% tax bracket pretty quick if we're successful. 30 years of real estate investing, right? Now, I would have to go make $55,000 to net $30,000, wouldn't I? Right? In income. All right, so I create a loan there and I take it the next year, $30,000. Now I'm going to pay that $62,000, so I'd probably take a $36,225 loan, pay the next year's premium, take another loan the next year, and I'm going to let that loan compound. And I got to tell you, insurance companies don't make bad loans. They can't inflate money. See, a bank can make a bad loan. They can inflate money. That can hide a bunch of sin or a bunch of mistakes. An insurance company can't inflate. So they don't make bad loans, I'm telling you, right? Number one, I can only borrow what I have access to in the cash value. I cannot borrow more than what I have access to. Okay. Now that death benefit, right, is going to collateralize that outstanding loan. So if I die, the loan's paid back plus the interest, then the net death benefit is passed to my heirs. Right, and here's the two things you always hear. Wait, I got to pay the insurance company money, interest, to borrow my own money? Well, correctly stated, no, my money's in the policy. I'm borrowing the insurance company's money, and of course they're going to charge me interest. Right, then we get into, who owns the company? There's only two kinds of life insurance companies in the world. Only two. Stock companies and mutual companies. Shareholders own the stock companies. They get all the profits because they're the owner of the company. The policyholders own the mutual company. The owners of the company get all the profits. Isn't that capitalism 101? Who gets all the profits out of your company? You're the owner. You put up the capital, took the risk, created the product, created the distribution system, put all the effort in. You deserve all the profits. So I'm using a mutual company. So I am directly supporting the profitability of a company that I own, and I'm indirectly supporting my policy because they're profitable, and I get my profits in the form of the dividend, right? So the first thing is I'm not borrowing my money, I'm borrowing their money. Yes, I'm paying them interest. Okay. Yes, it is. So you had access to the capital tax-free, and you left the remaining death benefit tax-free to your heirs. And we didn't call a single attorney that wanted $10,000 or $15,000 from the estate plan that we've got to change every 5 to 8 years because the estate taxation changes, right? Does that make sense? All right. Between now and then, if I divide this policy up over a 30-year time period and I divided it up into threes, the first part, the first third, and this is an exponential curve. Would y'all agree that that's an exponential curve? All right. You know, we all only have one exponential curve in our life. Only one. So how many times you can interrupt yours, right? And if this is a life insurance policy, isn't it going to, if it's on me, isn't it going to mirror my life insurance policy? Of course. So if this were me, and it's not, I'm not 39, right? I'm going to focus on getting money into this policy, capitalizing my system. And then I'm going to focus on using that money. I'm going to master the art of financing from this operating account, right? So these are loans that I'm going to pay back. And this shows and illustrates no financing whatsoever in loan repaying. If I did that, these numbers just go up. They get bigger, okay? But in the last third of this policy, they should be enjoying that tax-free income through loans. And that's all you're doing is leveraging a cash flow. If cash flow in is $6,200 in, there's a $24,000 increase. Isn't that a cash flow in, a premium? And a loan going out, isn't that a cash flow out? Now, I've almost got a money printing machine here. Almost. That's very good. The insurance companies set the rates, and today they're between 4.76 all the way up to 8%. Yep, typically, yeah. But you look, it depends on the loan, right? So if I'm a businessman, and I am, and I have access to $65,000 in capital here in the 4th year, right? And if I go down to my bank and I want to put all new IT equipment in my office, is my bank going to loan me money on IT equipment, $65,000? Well, maybe I'm a prime customer at the bank, right? But they're still going to charge me 6 or 7, right? Most banks won't lend money, so now I got to go to a leasing company. If I'm doing IT, that's my example. You know what the rate that the IT financing company is going to charge me today? 7.5, 8.5, 9, all the way up to 11.5 or 12, depending on how stout you are on your books, right? Well, this particular company charges 5%. I could have that loan check in my office in 3 days. I could have them wire transfer into my account, and they're going to charge me 5%. Well, I'm going to tell them when I'm going to pay them back, right? They're not going to require payments next month or collateral or 15 pages of documents. It's one page that I sign, one signature. But we're in Texas, I'm married, my wife has to sign two. 2 signatures, 1 page. Okay. And then I tell the company when and if and how I'm going to pay them back. Does that answer your question? All right. And I know I'm using $20,000. This you can move the decimal point either way. That could be a $200,000 premium. It could be a $2,000 premium. Right? The numbers work at whatever level. If you can wrap your mind around considering life insurance as a place to put money, right? And then you just investigate it, you will quickly see that it probably does make sense at whatever level, wherever you're at. Right now, let's say I'm already in business, and I am, and I already have cash flows. Can't I create a policy and just stick it right in the middle of that cash flow? Yeah, and it's going to be negative for the first couple of years, but very quickly it turns positive. This turns positive in the 5th year. $20,000 premium in, there's a $20,488 increase. Now, why would I lose money for the first 4 years? That was year 5, right? I didn't lose but $400 in liquidity the previous year, barely lost $2,000 the previous year. All of the startup costs, all of the cost of life insurance are weighted to the first 2 years of a policy. Right? But I can't get around that, neither can you. Right? Why would I do that? Well, look, in the 10th year, how many of y'all have children in here? What's the age of your oldest child? Can I ask? 7. You tell me how quick the last 7 years went. You know how fast the next 7 are going to go? Faster than that, right? 10 years is going to be here like this. So in 10 years, 6,200 goes in, and there's an $11,000 increase in a cash flow. Why wouldn't I do that? The only reason why I wouldn't do that is because I didn't know about it. I didn't know how to do it. I didn't know anybody else that was doing it, and I was too scared to get up and do it, right? Because if I knew what was going on with a thorough investigation, I'd be figuring out how to get $200,000 in there. Now we're just talking about leverage, right? 200. If I had to go borrow $200,000 and I have access to $132,000, y'all can't be scared of leverage in the real estate business, right? You can't be. If you are, it's, might not be the right business. I don't know. Okay. Any questions on that? And then, same policy, 39 years old, $20,000 premium, but the guy didn't quit putting $20,000 in for 20 years. He put $20,000 in for a 20-year time period. Remember, the first illustration was $20,000 for 7 years and no premium. $20,000 a year was $6,600 in premium, and then $20,000 a year for 20 years. All right. In the 20th year, this guy's 59. He puts in a $20,000 premium. There's a $40,000 increase. Where can you do that? Now imagine that you have the real estate cash flows or any kind of cash flow. Can't we use a cash flow for a premium? Of course we can. That's all a premium is. It's coming from either existing assets or cash flows. Yes, sir. Okay. He's like, where does the money come from? Does it just grow in your account? Do they send you a check? Or right? I control that. I can tell them to send me a check, right? Or I can tell them to go right into the policy. That's compounding. All right. Now, I have access to that money. Here we're in year 20. We're in year 20. That's a $40,000 increase in that year. Now, if I tell them to send me that check, I'm in essence neutering the power. I'm interrupting that compounding. So all the numbers after that are going to be less than what you see. So I would not do that, personally. I would tell them to keep it in the policy. I have access to that $40,000 through a loan or withdrawal. If I withdraw it, it neuters the compounding, and then I got to start the compounding all over. Right? If it stays in the policy, I'm just going to tell them to send me a check, but I'm going to do it in the form of a loan because loans are tax-free and I control the loan repayment if there is one. Now it continues to compound. The premium in, the loan out, the compounding's not interrupted. And it does that. If we look in the 20th year, I'm looking at the end of the 19th year, I have $502,000 in cash value. Man, I can go buy an apartment complex for that. How many homes can I can go buy 20 homes with $500,000 today and leverage those up and still control the leverage. Right? Can I? Couldn't you? Yes, you could. The dividend, where's that $40,000 coming from? It's coming from the dividend of $8,000, and then it's coming from the interest on that $500,000. The previous year, there's $500,000. That $500,000 is earning interest. I get the interest plus the dividend plus the $20,000. That's what created the $40,000 increase. It's not magic, right? I mean, so the cash value is earning interest, and man, it's next to nothing. It's pitiful. Well, compared to what? All right? So if you look at the internal rate of return, I don't know what it is on this policy, but I'll bet you it's only about 3.6%, the internal rate of return on that cash value. Right? All assets have a rate of return. And look, we're in the lowest interest rate environment ever. So America is obsessed with interest rates. What's a rate? What's a rate? What's a rate? Well, I can't control what the interest rate is. Neither can you, neither can the insurance company. They can control it very little. They have a little bit of input, but not much. Okay, I don't care what the interest rate is. I know what I can do with that $500,000. But now I can calculate an internal rate of return, which is what I encourage my clients to use, internal rates of return. Because with an internal rate of return, you can compare assets to assets, no matter what asset class they are. You can compare a stock portfolio with a real estate portfolio, with a bond portfolio, with a farm, right? All of them have an interest rate associated. They all have different cash flows, so we can determine what the net rate to the owner is through an internal rate of return. Does that make sense? Okay. So look, the cash value has an internal rate of return. I'm telling you, I'll bet you it's about 3.6%. And it's tax-free. And you're in the 50% tax bracket. Well, that's the equivalent of almost a 7% rate of return, every bit of a 6% rate of return, right? Now, the mentors in real estate that I have, they say, James, over good times and bad times, all real estate produces about a 6% rate of return. Buy and hold, flipping, single family, multifamily, commercial. That's what their experience was over 55 years. That's good enough for me. I mean, that's okay. All right. So there's an internal rate of return on the cash value, right? And now if I die, there's a check that's going to my family. There's an internal rate of return on that death benefit, right? And the longer I live, that goes down. Because look, if I put 20,000 in, died tomorrow, 577, that's about a 14% rate of return. So the longer I live, the closer I get to death, that rate of return gets down to about 7 or 8, tax-free. Right? So there's an internal rate of return on the cash value, internal rate of return on the death benefit, but now we're talking about a cash flow. If that's a premium in, that's a flow in. If that's a loan out, that's a flow out. So what's the rate of return on that cash flow? Okay? 20 in, 40,000 out. What's that rate of return on a cash flow? Come on, y'all, that's simple math. Isn't that 100%? If I put 20 in, can get 40 out, isn't that 100? All right, that seems like a big number, but I'm discounting the loan, right? The loan is not in that equation. Why not? Because the death benefit is going to collateralize that loan. So I can comfortably take that out of my cash flow equation. Thanks for watching. If you enjoyed the video, leave a like, and if you think it was helpful, share it with a friend. If you want to see more videos like this, then subscribe down below and click the bell icon so you can be notified when we release new videos. And we are releasing new content all the time. Don't miss it. Thanks for stopping by.